Thank you very much, Tyler. And Brian, good afternoon. Thank you for joining us. Fresh off these results that the market appears to like very much. Stock's up 6.3%. How much of a driver do you think rising rates are for your business right now?
Well, Sarah, thank you for having us. And, in the end of the day, the banks make about more than half their money through the balance sheet, and that's the difference between the spreads we lend money at and pay our depositors. And as rates rise up, our zero-interest deposits, which are a core part of our franchise, and our low-interest checking obviously become a lot more valuable, and that's where you saw the strong gain in NII, not only year over year, but also linked quarter, up over $1 billion plus from second quarter to third quarter. And we told people it'd be up over $1 billion in the fourth quarter, $1 billion a quarter. And that's the earnings power coming back as the rate structure comes off the floor it was at for a couple of years during the pandemic.
Yeah, that guidance people appeared to like as well. So what level of rates do you need to see, Brian, to get expanding operating leverage and margins?
Well, the level of rates is going to be determined by what the Fed's doing to take out monetary accommodation. So you have to back up, and we're working against an economy which is still solid now in terms of customer activity and what we're seeing. But our experts in Candace Browning Platt's research team, who often here on your show, have the third quarter still positive. They had the fourth quarter, the first quarter, the second quarter, the third quarter next year is all slightly negative, and it comes back to positive. And that they have a rate structure that gets up to about 5%. So we don't need a rate structure. We're earning this much money today with the current rate structure, and some of that's still to kick in. But the reality is, if the rate structure is there because inflation's gone too far and they can't get under control, that has other issues in the balance sheet. So you got to be careful what you wish for in the world that we're in financial services. So our job is to meet anything, be prepared for everything. But the good news is the consumers and the commercial activity still remains very solid deep into the post-pandemic era.
No, I think your comments on the consumer are really important, Brian, and they stand in contrast to what it feels like following the markets lately and in other industries. So what are you seeing right now that's giving you so much confidence to talk about a strong consumer?
So if we back up, we have 60 million consumer households. We have 35 million Americans' core checking accounts where the money comes in from getting paid and they distribute to pay their bills. And we have their 35 million plus credit cards and all the other things that come with that. And so if you look at that spending for the third quarter of 2022 versus the third quarter of 2021, it was up about 10%, and transactions were up 5.5% or so. As we look at the first couple weeks of October, it's still up 10%. Now, that's a tale of a little bit you got to be careful, because earlier in the year it was growing faster, and as the environment's changed, they've slowed down a little bit, but still much faster. So if you think about maybe 2017 or 18, it might have grown at 5 or 6%. It's still growing faster, which shows the consumer has money to spend. So number one, they're spending. Number two, they have as much money in their accounts today as they did at the end of September as they did at the end of August. And that's interesting because most people believe they're spending it down, and you don't see that yet. Now, is there stress for certain consumers out there? No question, but they're employed and earning money, and their account balances at Bank of America continue to be flat August to September for cohorts that had 2,000 to 5,000 before the pandemic, an average of 3,400. They're sitting with 13,000 in account, and it's not going down. It continues to be flattish, and it was growing early in the year. Now it's flat. That means they have money to spend. And then on top of that, they're employed, and you can see the unemployment numbers are still very low. So you put that all together, the current environment of consumers is quite good and strong. When you go to the credit side of it, they have plenty of credit availability, and our charge-offs and our credit delinquencies are still way below they were pre-pandemic. But even if you look at the best 5-year averages across the last 30 years, they're still below that. And so that means the consumer, because they're employed, they're paying their bills. That's sort of basic stuff. Where it goes in the future, we're not reflecting on today as much as talking about what we see today. And then you go to commercial, it's the same. Charge-offs low in commercial, continued improvement in reserve criticized loans or non-performers, all good stuff because the environment's still strong. Now, are we dealing with issues all over the place? Absolutely. Are we dealing with a higher rate structure will drag the economy? That's what the Fed's trying to do. But right now, as you see the third quarter and the first part of October, the consumer's hanging in there.
Shepard Smith here. Thanks for watching CNBC on YouTube.